This is the Landlording for Life podcast, where landlords explore their success and stories of failure while building a foundation to improve upon. Here is your host, Sean Morrissey.
Hey everybody, welcome to the Landlording for Life podcast for this week. This is your host, Sean Morrissey, and as always, we appreciate you tuning in. So today we have on the line a gentleman by the name of Paul Winterowd, and Paul is a director with Bonneville Multifamily Capital. So we're going to go into a little bit of detail today on multifamily financing, really at $1 million and up, and Paul's going to give us some pointers along the way. So Paul, welcome to the show.
Hey, great to be here. Thanks, Sean.
Awesome. So, Paul, tell us a little bit about your background and how you ended up in the world of multifamily financing.
Yeah, no, it's been a fun run for me. I was a golfer growing up. I guess I still am a golfer, but golf was my passion all through primary school and high school. I had the opportunity to play collegiately, and that was my focus.
Oh, great.
I was in school, but I wasn't really focusing on a career or even thinking much about what I wanted to do after. But I knew if I had to support myself by my golf game, I would be very hungry. So I knew golf wasn't in my future professionally. Interestingly enough, my first job, if you will, out of college was I got my residential real estate license and was trying the residential agent game. Completely not knowing what I was doing. You know, I was in that game, but my dad gave me, what he thought was great advice at the time, get a real job. And so I, through my 20s and, I stumbled through a handful of jobs that I really didn't like. And I was always interested in real estate. And I did probably my first flip in, about 2004 and, made a couple grand and did a couple spec homes where I made some money and lost some money, but I was always like poking at real estate, having an interest, but not really completely immersed in it. And I got to a point where things weren't really working for me as far as my career. I wasn't really happy or satisfied. I'd had success, but I was just completely uninterested in what I was doing. And so, I decided to go back to school and do the full-time MBA program, focusing more on finance. I'd certainly been in the sales and marketing side and had some experience there, but used that to land my gig at Bonneville now, and have been a commercial loan officer and director there now for about 4 years, and really focusing and completely immersed in commercial real estate on the multifamily side and providing loans there. And it's truly my passion. I feel so blessed to be where I am and have the opportunity to help people and really care about it. And as I've been more immersed, I've been able to acquire a few properties myself. I currently have a 4-plex, 7-plex, 13, and an 18-plex. So I've got
fantastic.
4 multifamily properties that it's been a great learning curve, but I feel it's important that I'm in the game, and I have, I can help my clients understand what they're going through because I'm in the space as well.
Yeah. I mean, you're practicing what you preach, which is fantastic. Now, do you manage those properties on your own, or do you hire professional management?
The 4-plex is where I started, and I would tell everyone that's a great place to start. It's the closest thing to commercial, but still benefiting from some of the residential loan terms, and it's easy as an individual to start there and to get some experience. So I do self-manage that. The other properties, I do have a third-party property manager.
Okay.
I'm based in Salt Lake City, Utah, and all those properties are local.
Okay, fantastic. Yeah, that's the way I like to do it too. Keep it local. Well, tell us a little bit about Bonneville. Now, do they do strictly multifamily financing or all types of commercial products?
We do have 2 companies. There's one that does all sorts of commercial finance, primarily funded through the life cos or life insurance companies. On the multifamily side, which I'm a part, we do specialize in multifamily. The reason there's a distinction and actual, call it a specialty there, is there are different programs for housing, for apartment buildings, and that's that's by and large coming from the government, whether it's through Fannie Mae or Freddie Mac, which are government-sponsored entities, or they're called the agencies, to programs like USDA and HUD, FHA, where they're insuring the loans. So the government has an incentive to provide housing for its population. And so in the commercial multifamily side, there's better terms that have been enriched, and the government has got involved to help keep that market essentially liquid and moving, and so people have a place to live.
Okay.
So,
okay. Very good.
I really specialize on the apartment finance, and we're typically looking at loan sizes $1 million and above. And that's, I like to say it's a semi-hard line in the sand. It's not an absolute. The reason for that line is simply because some of these programs that offer the better terms are, Fannie or Freddie, and they have loan minimums of $1 million. But what we do is we go out and we survey the marketplace, and may get into this a little deeper, but we make it our business to know all the lending options available to our clients, so they can come to us and we can marry them with the right products based on their goals and what they're trying to accomplish. And that, certainly is contingent on a hold period, and, if cash flow is important or what it is. And so there's a lot of different factors, but we make it our business to know the whole marketplace,
what's going on out
there.
Okay,
yeah.
Got it. Well, and that's a good transition point, because when it comes to the type of client you're looking for, particularly in the multifamily space, how would you describe that client? I mean, I guess they're looking for a loan product of $1 million or more, but what might be some of the other variables we'd want to take into consideration?
Yeah, really the first thing to consider, and an early conversation we have is that of a credit standpoint. And there's a lot out there, and especially if someone's a beginner to commercial real estate or commercial multifamily, they're like, hey, I heard the property just can support this, and give me a loan. But there are certain credit parameters, some basic general, and this isn't absolute or universal, but it's a good rule of thumb, and it's a good metric to measure yourself on as far as qualifying from a credit perspective. And from a credit score, we like people to have at least a 650 and above.
Okay.
The higher the better, but if it's below that, it's a story. And there are loans out there for that, but there's a premium for those, right? You're paying more. But for the best rates and terms, we want to see a 650 credit score. And then there's a net worth component. We like the net worth to coincide with the loan amount. So if we're looking at a $1 million loan, we like to see the net worth of the borrower or the borrowers equal to $1 million.
Okay.
And what we see, Sean, is that most times people getting into this business don't necessarily have that meet that criteria on their own. And so they get together with a couple friends or through networking, and they partner on deals. And so collectively they meet that. So if you're looking at a $5 million loan, right, that could be a big threshold. But if you put 3 or 4 guys together, guys, gals, I use that term interchangeably, of course, you all of a sudden you can qualify from that net worth standpoint.
Okay.
And then the third thing is liquid assets. From a lending perspective, it gives us confidence to know that our borrowers aren't putting their last nickel into the deal, that there is some money on the sidelines. And a good rule of thumb, a conservative rule of thumb for liquidity or liquid assets on the side, and liquid assets or cash-like assets such as stocks or bonds. We like to see that at about 10%. And again, that's on the conservative side. We certainly do loans that may be in the 5% range, but if you're, putting together your own personal balance sheet, it's good to have 10% of your net worth in cash or cash assets to meet that criteria. So again, using that example of $1 million loan, If you had $100,000 in cash, and that would be after your equity contribution, that would be more than enough to qualify.
Very good. Now, are you looking at figures like 6 months of mortgage payments in reserve on top of that, or is it strictly just that 10% liquidity, would you say?
Yeah, and it's a little of both. That liquidity is not held in escrow, or it's not in a reserve account, but it is a metric. For example, Fannie Mae and Freddie Mac loans, they require a 9-month principal and interest liquidity standpoint or threshold, and so when you do the math, that's usually in the 6 to 8% of the loan amount range, and so that's why I say, hey, if you're at that 10%, you're more than safe.
Okay, very good. Are there any other ratios that come into mind that you might look at that would be valuable to listeners at all? I mean, credit score, liquidity, does experience come into play at all?
That's a good point, Sean. Experience certainly helps, and everyone has to start somewhere. And we do a lot of loans for people that are doing their first commercial loan. Typically what happens, and it can be program to program, there are some variances there, but the best way to do that is to partner, or have a partner in the deal that has done similar deals in that space. So experience is certainly going to put some surety in the mind of the lender, just because they've been there and done that, and there's a track record, and that helps. But it's not an absolute requirement, and again, that can be mitigated through the partnering. The other important things that we like to see right out of the gates are a personal financial statement and a schedule of real estate owned.
Okay.
Sometimes they're one document in the same, but that just will detail, your assets, and that'll define the net worth. And so those are things that a lot of times when we, are initiating conversations with our clients, we're asking for those. And as if a borrower wants to look sharp and impress a lender, having those readily available and updated to provide right out of the gate is important. I will say, just wrapping that up, there's a million different ratios out there, debt to income and global cash flow, and several different things, and again, that varies from program to program, and some bank type loans get more into that, but in the space we're in, again, call it the secondary market, where we're talking about non-recourse loans, agency or federal money, or insurance companies. Those initial credit requirements and documents that we've chatted about are really what
the
we
most important.
Look at and what's most important initially, yeah.
Well, and you brought up a good point there too, where if you don't have the experience, or even on the flip side, if you do have the experience, I mean, that could be a fantastic opportunity to partner up with somebody that might bring you a building that they're just falling short on based on either the net worth or the experience level. So food for thought to our listeners out there. Now, when it comes to, on the flip side, I suppose I should say, when it comes to the investor looking for the type of financing they need, and they may talk to, this day and age, a handful of different finance companies. What do you think those individuals should look for out of those finance companies, or what questions do you think they should ask before moving forward on a loan product?
Yeah, that's a great question. And, we're familiar with our local banks, right? And even regional banks. We go to a basketball game or a football game, and we see the local bank up on the billboard, and we go there to, deposit our checks and, withdraw cash. And so a lot of people default to, hey, I need a loan, I'll go to my bank. And that's a good place to start to familiarize yourself. But what you got to keep in mind is that bank has a very specific credit committee and a very specific appetite for risk and asset class. And that could very easily not align with what you're trying to do. So you may be turned down, or you may need to talk to a dozen different banks to get the the type of loan or the approval that you're looking for, because although banks are the same, they're disparate in what they're looking for and what they have an appetite for, and the terms they'll offer and what they'll approve. With most people are probably familiar with groups like a lending tree concept, right, in the residential space, where when banks compete, the borrowers win, or whatever the tagline is. I can't remember exactly, but you get multiple offers to compare, and I think that's really important. And again, I'm certainly biased in this regard, but what we do is, our mission is to maximize our clients' return on investment by understanding their goals and what they're trying to accomplish. And so our business is really to understand not only what a myriad of different banks offer, but also other programs from insurance companies, from CMBS, which is Wall Street, to Fannie, to Freddie, to HUD, and whatever else there is. And so it's a lot to take in, and even private lenders as well. And so what I would recommend is ultimately you're going to be best served by working with one broker. Now, you may need to interview several brokers to find the right fit and find someone that's going to meet your needs and has the network and access to all the capital that you need. But once you've determined who that fit is, that broker is going to be able to go out and find you the best rate and terms based on what your criteria is and what you're looking for, and then you can develop a relationship with them. What happens, and we've done it lots of times, and it's frustrating, but we start working on a deal and we find out there's 3 or 4 brokers working on this, and before you know it, the brokers are sending the loans to the same lenders. The lenders are frustrated because it doesn't look like anyone has control of the deal, and your terms actually get worse, and it actually really frustrates lenders. It may seem counterintuitive, but if they're
that's
seeing
interesting.
the same deal from 3 or 4 different places, they're just going to be like, hey, there's no loyalty, there's no real surety that we're going to do this, and time is money. So people will work on deals where there's a reward, or there's compensation for that. So by working with one broker that can bring you that, you're actually going to get better terms and better service, because you know that they're committed to you, and vice versa.
Yeah.
And so that would be my
said.
best recommendation. I'm not saying that's me, but finding a good broker that can bring all the options to bear and staying loyal and true to them will ultimately serve the borrower in the long term.
Well, and it's funny, because I think what I've learned over my term of working with commercial financing, and back to your point of, let's say you start with your local banks and you make a phone call or two and you present some numbers on a building to them, is that they do offer a different amortization period, naturally a different interest rate, maybe a different balloon. So finding that appetite for that particular bank is critical. But I have not thought about just going to a broker and really just developing that relationship. And to your point, interviewing those individuals is going to be important to make sure they're going to suit your needs. But that seems it seems like it's fairly common sense, and it just hit me today. So that's good stuff. Now, what about with the financing products you see right now? What would you say is your favorite form of financing you see out there right now? What's one of the products you see that, perhaps it might be difficult for somebody to qualify for, but the terms on those are just incredibly favorable?
There's lots of programs, and my first answer is it really depends on the client's goal, and that I'm not trying to be a cop-out, but I try not to be partial to any one loan program over another, because there are different goals and different needs.
It makes good sense.
Have. But one thing that really is becoming quite popular, and it really is applicable for those starting out or just getting into the commercial multifamily space, would be the Freddie Mac small balance program.
Okay.
This was a program that really had its inception in 2014. It's a new program, but it's getting legs. What had happened is Fannie Mae and Freddie Mac have done commercial multifamily loans for decades. And there's only a handful, meaning about 20, 25 of these national, big, large companies that have been given the authority to administer these loans and be lenders for these loans. And they're competitive, but they've by and large been in that space of 5, 6, 7 million and above, even 10 million and above. And so there's just no interest. There hasn't been any interest in this, call it this mom and pop space of $1 to $5 million. But there's great terms, 30-year amortizations and 10-year fixed rate terms and, assumable and non-recourse and some of these things that you just can't find at banks. So the mom and pops have really been, or the individual investors like you and me that are trying to build up a portfolio, our only option was the banks. And so this Freddie Mac small balance program, and there is a Fannie Mae as well, but it doesn't have the same prominence or success yet. They're trying to catch up, but it's really geared towards the smaller type loans to provide the same sort of terms, and in some cases even better than the larger $5+ million loans. And that program starts at $1 million loan amount, and we've talked about that. And it's a streamline. It's about a 60-day process, start to finish, and so it works great for purchase acquisition and provides great cash flow and surety to the borrower as well.
Okay, good stuff. Yeah, we'll have to Google that. Freddie Mac Small Balance Program. Is that the name?
Yep.
Okay, fantastic. Yeah, we'll have to dig into that and maybe try to include that in the show notes as well. Now, what about?
You'll see Freddie Mac SBL, those initials as well.
Okay, Freddie Mac
that's an
SBL.
easier thing to Google.
Okay, fantastic. Now, what about real estate syndications? Meaning, a group of investors come together and they buy a building together, either as an LLC or something of that nature. How often do you tend to see those this day and age? And what might be some of the particulars you'd point out to folks that are thinking about doing a real estate syndication at this point?
It's far more common than not, Sean, in my experience. And so, as I was talking about the credit, as people can start extrapolating, if I'm trying to buy a $2 million property or $3 million property, I may just not be able to do that on my own. And so typically there's a partnership, and then quickly people will realize, hey, if I can bring in some friends and family, and before you know it, they've got a syndication going, and it's actually quite common. And most of my clients are looking to grow and build a portfolio, and in order to do that, to continually acquire and build, you run out of your own money before you know it. And so doing a syndication is the way to achieve that and do that. So it's actually quite common. And a couple of the key things to consider, it really doesn't change much of anything from a loan perspective. We still need those sponsors, guarantors, general partners. There's lots of different terms out there for that. But to meet the credit requirement, and then the equity, in fact, closing a deal Friday that the sponsor doesn't have any of his own equity in the deal. He's raised all the money from. It was a simple syndication, friends and family. Initially, he was going to put some 1031 money and got some interest, and before you know it, he's the general partner. He's doing the deal, but he's raised all the equity to do it. So the biggest hiccup that you can hit, and again, different programs have different requirements, but as long as none of your limited partners or investors have 20% or more ownership in the deal, then they will not be underwritten or looked at from a credit perspective.
Got it.
So what I recommend is when it comes to actual ownership of that LLC, make sure everyone's under 20%, and then they won't have to be, looked at or scrutinized by by the lender.
Okay. Good stuff there. What about any other recommendations you might throw out there to folks that are looking to pull down their first $1 million building or more at this point? Any other words of wisdom based on what you've seen in the past?
Sure. The biggest struggle that we have as people are trying to acquire properties is getting the financials. There's basically anything we do, we have to underwrite to what is existing, what has been occurring. The only exception to that would be some, construction or true value add play where it's all what it's going to be. But if there's any sort of, hey, this is how it's performing and this is the financing I need, I got to have those financials. So the key things to ask for and to track down is a current rent roll.
Okay.
The more detail that can be on that rent roll, the better. So, of course, current rents, collections, market rents, but move-in dates, lease termination dates are crucial. This is information you want to know when you're buying the property anyway. Who's in there? How long have they been in there? When are they going to leave? What are they paying? Is there opportunity to improve that? What other income is coming in as well?
Okay.
And then the other key financial piece of information we're looking for is a trailing 12-month operating statement. And so we want to see what the property's done for the last 12 months on a month-to-month basis, essentially detailing your income, your expenses, and getting to that net operating income. And Sean, it's amazing how many properties have incredibly poor records. And
I know it.
There's so many individuals that don't necessarily treat this business like a business, and I think that's a huge opportunity for aspiring landlords and owners to treat the business like a business, to have a CPA, to have a property manager, property management software, so you can keep track of the financials of what's going on. I mean, we're in this to make money, and so if you don't know what's going on, it's crazy. But I've looked at deals, even within the last year where owners selling a property didn't even have a separate bank account. They were operating, I think it was a 20-unit property out of their personal checking account, and there weren't any records at all. And so that can be a challenge, but in order to do a deal, to get a loan, you're going to need those financials, and those are the basics. It always helps to include photos of a property, both interior and exterior.
Oh, that's a great point.
It really helps, tell the story. It seems obvious, but where the property's located is also a big factor. What's going on economically around it? Is there jobs? Is there population? Is there growth? Is there schools? Or is there military bases? And again, not to point out some of the pitfalls, but a lot of times people will say, hey, I got this great property. It's right next to a military base, or it's in this college town. And this is great because there's, military personnel or students. And actually from a lending perspective, we look at those as risks. The risks because if a college is driving the whole economy in a town and that college or university shuts down, well, what's going to happen to the town? The town's likely going to
fold
have
as
some
well.
real
Yeah.
Same thing with the military base. All of a sudden, a military base closes and you're in trouble. So, there's just little nuances to think, oh, this is a great thing. Well, actually, from a lender perspective, we don't necessarily like that, and that may just change the terms of what you can get. But there's where there's a will, there's a way. We can work through that. And the last thing on that thread that I'll mention, for permanent financing, a good metric to keep in mind is 90 for 90. And what I mean by that is 90% occupancy for 90 days or 3 months. So on a trailing 3-month perspective, we really like to see at least 90% occupancy. When we dip below that, it just gets harder, and there's some more questions. It's a robust economy right now, and multifamily is great. stabilized properties, it's rare to dip below that, but there are scenarios where that comes up. So just take a quick look and make sure you've got occupancy of 90% or greater for the last 2-3 months.
Oh, that's fantastic. Yeah, I didn't learn that 90 for 90 rule, so I appreciate you pointing that out. But when it comes to the trailing 12, I mean, it's funny. I can think of, all sorts of situations where, numbers have been presented by a seller or a listing broker. And so long as you do your due diligence correctly, I mean, you can use all that to your advantage. So, I mean, recently, like we had a scenario where utilities were quoted to be about 35% lower than they actually were once we got the last 12 months of water and electric bills. And we were able to use that as leverage to knock, roughly 8% off the price, or $50,000 roughly. So, I mean, you could use that stuff.
A couple hours of time, right?
Yeah, exactly. I mean, that's why you do your due diligence and you double check what the seller presents to you. Okay, so Paul, we're kind of wrapping things up here, but one thing we tend to ask everyone that's on the podcast is a book or a website they may recommend to our listeners to check out. Do you have anything off the top of your head that you think is golden?
This isn't necessarily a real estate book, but it's a great read, and it's a great kick in the butt, if you will. It's called The War of Art by Stephen Pressfield.
That is a new one. Okay.
It's different. If it's different than The Art of War, of course, but the War of Art is really an interesting book about focusing on your craft and your passion and some of the resistance that naturally comes around it, and it's an eye-opener, and it's a good kick in the pants and good motivator.
Okay, good stuff. I'm gonna have to check that one out myself. I haven't even heard of it, so looking forward to that. And then, what would be the one piece of advice you might provide to an aspiring landlord at this point? I mean, now you've been a landlord for yourself for several years, but if you were to look back and perhaps give yourself one piece of advice, what would that be?
Yeah, and this isn't original by any stretch, but fail fast. I think there's such wisdom in that. My biggest regret is not doing more sooner. I believe that the multifamily real estate investing game is a get-rich-slow game. Now, there's certainly some big gains, and people can make a lot of money relatively quickly, but by and large, the people that are in this game for a long term become very wealthy. But it doesn't happen overnight. And so the quicker you can fail, the more you're going to learn. And we naturally avoid failure. I do the same thing, but we learn the most from the mistakes we make and the things that we don't do exactly perfectly. So I would
fail
say fail
fast. Yeah. Okay, great. Good stuff. And then what would be the best way for our listeners to contact you if they have interest in any of Bonneville's products or maybe a question or two?
Yeah, happy to help. Easiest would be email for me. And my email address is simply Paul, Paul, at bmfcap.com. So B is in Bonneville, M is in multi, F is in family, cap, short for capital.com.
Okay, awesome. Well, Paul, I think you provided a ton of value today. Thanks so much for being on the podcast.
My pleasure. Happy to join. Thanks, Sean.
Yeah, great stuff. So everybody, thanks so much for tuning in this week. I hope you found as much value from this as I did, and we will see you next week on the Landlording for Life podcast. Until then, keep landlording, and we'll talk to you soon. Bye-bye.
Thanks for listening to another episode. If you like what you heard, leave us a 5-star review and join our Facebook group to share your deals and ideas by searching at Landlording for Life. See you next time.